The broadcast is now starting. All attendees are in listen-only mode.
Good evening, Marshall Reddick Real Estate investors. Thank you so much for joining us tonight for our webinar that's going to cover all things 1031 exchange. Really glad you could all join us tonight. I see a lot of seasoned and new investors, so it's a pleasure to have you all joining us tonight. I want to get started tonight talking a little bit about what Marshall Reddick Real Estate is all about. We do three things you'll see up here on the screen. We're a real estate broker, so we represent buyers and sellers here in our local California market. We are a private money lender, so we help to loan money to those who are unable to qualify for conventional financing. And we offer that for our borrowers as well. So you can borrow money privately, you can invest money as well into notes and trust deeds. And we're also a property manager here in our local market from Orange County up to LA County. And we work with our clients in all three of these areas, including connecting our investors with our out-of-state teams so that they can purchase property all the way from here in California to Indiana, Texas, Florida, and everywhere in between. Dino, go ahead and put me to the next slide, please. Thank you very much. So here at Marshall Reddick Real Estate, we want our investors to be able to use their hard-earned money. You're working your 9 to 5, and we want you to use that money to invest. So we offer educational courses such as this webinar you're listening to tonight. We offer live events as well for you to go out and participate and mingle with other investors who are looking to do the same things you're doing. Our consultations are free with real estate advisors such as myself, and we spend the time to look at properties, to look at the different type of investments that we have to offer, and really narrow down which one is going to work the best for you, your investment strategy, and your goals. And in that, real estate is a team sport. There's a lot of moving pieces and there's a lot of players involved. We want to make sure that we have that team set up before we get on the field. So everybody from your real estate advisor to your mortgage lender to your insurance agents are all going to be really key people in the process of purchasing real estate. And for those of you who are looking to sell and defer the taxes and purchase more real estate, a 1031 exchange is also a key piece of that. And you're going to need a qualified intermediary to help you through that process. And that is what we are here to talk about tonight. Dino, next slide. Dino?
I did.
Oh, thank you very much. I'm a little bit delayed on my side. Sorry about that. So like I mentioned, I'm a real estate advisor and a California realtor here at Marshall Reddick Real Estate. My name is Kristen Tabar. I've been licensed here in California for almost 3 years now. I went to school at Cal State Long Beach to be a teacher, actually, so I've got an expensive piece of paper hanging on my wall that I'm currently doing nothing with, but found my passion in real estate and I haven't looked back. My husband and I have been investing together out of state, actually using the Marshall Reddick Real Estate teams for the last 4 years. And that's how I actually got familiar with Marshall Reddick Real Estate and found the company as an investor first. So I started investing and seemed like a natural fit to kind of move into a position where I got to not only pursue my own goals as an investor, but also help others to do that as well. And so now I have the privilege of working with many of you who are already on the call tonight and with many of you who I haven't met yet. And I look forward to having a conversation with you and talking about what your goals are and seeing how I might be able to help you. Dino, next one, please. All right, so we're going to get ready and go ahead into the main event here tonight. I know you guys definitely signed on to listen to me talk about myself and what I do here, but Dino Champagne, our qualified intermediary for 1031 exchanges, is going to take this away from me here in just a minute. She's been working As a qualified intermediary for the past 14 years, she's been with Marshall Reddick for just about that same amount of time and working with hundreds of our investors to ensure that the process runs smoothly. She's extremely experienced and dependable, and with her and her team over there at Asset Preservation, Inc., you will be in great hands for your 1031 exchange. So without further ado, I'm going to hand it over to Dino Champagne.
Thank you, Kristen. I hope everybody's having a great evening. I would ask you for feedback, but I don't think I'm going to get any since this is a webinar. Just a little bit more about who I am and Asset Preservation. I was talking to Kristen earlier, and I said I'm on the 14-year plan. I've been with Asset Preservation for 14 years. I spent 14 years as a commercial broker prior to joining Asset Preservation, and prior to becoming a commercial broker, I spent 14 years as a banker. So the joke is now, what am I going to do in my next 14 years? Well, let's just hope that they still have a 1031 code and I can still continue to do this, because this is a fun industry and I really love what I do. Asset Preservation, we're a national 1031 qualified intermediary. As a company, we've been around for 25 years, and we have facilitated over 160,000 exchanges nationwide. We work with all size investors from from REITs to institutional investors, all the way to the mom and pop investors looking to sell their single-family rentals to and hopefully build up and build their portfolio. Asset Preservation is a wholly owned subsidiary of Stewart Title Company. Why is that important? You're going to know in the end, because in reality, the 1031 industry is not a regulated industry. So it's important to know who is backing what it is we do.
I think I heard it go doo-doo-doo.
Okay. And on the slide it says that I'm an avid golfer. I think Scott put that on there and Kristen put that on there for fun because they've heard me talk about my golf. I'm avid but lousy. So the president of our company says that my golf game is good enough for API. It doesn't embarrass the company, and it shows that I'm not spending all my time on the course. So that's a little bit about me and the company, Asset Preservation. Okay. On this next slide, what you see actually is a transaction that we did. So people actually do end up with property when it comes to an exchange. And so you see that when there's an exchange, there's a property that actually gets to the end. So here's an example of a property that was exchanged into Austin, Texas. So just a little visual of what it looks like at the end of an exchange. Mind you, I'm not anywhere around any of that. I'm merely just the accommodator. That's what the team is for, to help you out to find the property. Okay, what we're going to cover tonight, now this subject is something I can speak on for probably 3, 4, 5 hours, but I don't have that amount of time. But what I'm going to do is give you the highlights of the 1031. The information I'm going to share with you tonight is not everything about a 1031. It just gives you the basics. And there's always some nuances and some twists and turns into any transaction. So just understand that this is just the basics of the 1031. If you have any questions about your specifics, if we can't cover them tonight, you've got my number and contact information is there, or you can get it through the Marshall Reddick group, and then they can forward it on to me and we can have a discussion. Okay, so what we're going to cover is capital gain taxation. We're going to go through what the tax rates are, what an investor's looking at. I'm going to show you an example. If somebody sells an investment property and chooses to go out and buy an investment property, as opposed to sell an investment property and do an exchange. Believe it or not, there's a huge difference between the two. We're going to talk about pros and cons of exchanges. Like any transaction you do, there's always going to be something that's in favor and then something that's not so much. We're going to talk about exchange terminology. I'm going to just, for those of you that are not familiar with exchanges, as like every industry, we have our own lingo. I'm going to highlight just a few aspects of the language that you could possibly hear when we talk in the 1031 world. I'm going to cover IRC Section 1031, so basically what qualifies and what does not. We're going to go over what is like-kind property. I'm going to tell you about the exchange equation. I'm going to take you through the delayed exchange format, the identification rules, and then basically what kind of due diligence and questions you might want to ask the qualified intermediary that you're looking to work with in your exchange transaction. And if we have time, there's going to be some time for questions and answers. Okay, at this time, I'm going to turn it back to Kristen because she's going to take a quick poll. Don't worry, it's not a political one.
Yes, hold on to your hats, everybody, but don't worry. We're not going to ask any political polls tonight, I promise. We are going to just do a couple of quick polls here. I know you guys thought you got to kick back and relax through this presentation, but we're actually going to go ahead and do a couple of quick poll questions. The responses are completely anonymous, so don't worry about your answers turning up on the 405 freeway on a big billboard. Won't happen. But the first poll question here, which of the following describes you? Go ahead and select one answer of the following choices. I have property with equity I'm considering to exchange. I own property but not yet in a position to exchange. I don't own property yet and just want to learn. I'm going to give everybody just a couple of seconds. Sometimes I sing the Jeopardy theme song, but I don't want to hurt anyone's ears tonight, so I'm going to refrain. I'll give you just a couple more seconds here to get everybody's answers. All right, looks like I've got most of you in here. Thank you so much for your participation. Let's go ahead and share the results.
Okay,
so
Vanna,
like
which
just
they win?
Well, this is how the results turned out. A little more than half of you have property with equity and are considering doing a 1031 exchange. So awesome, you guys are definitely in the right place. You're going to get a lot of good information tonight, and hopefully we'll have you hooked up with Dino so she can help you out with that. 32% own property and are not yet in an exchange position, and 16% of you are eager out there and eager to learn, and I'm happy to see you here getting all the information that you can. And that is going to conclude our first poll. Dino, I'm going to go ahead and send it back over to you.
Very good. Okay, so for those of you that are in the position of considering you have property, you have equity, and you're thinking about potentially doing a 1031 exchange, anytime somebody's making a decision as to whether they want to do a 1031 exchange or not, the platform in which they're going to begin is going to be, what am I going to be paying in taxes? So the first thing to understand is the taxes that an investor is going to face when they sell an investment property. Now, when you own an investment property, as most of you know, you have depreciation. And all the years that you've been owning that property and depreciating that property, you've been lowering your real estate taxable income during the years of operation. So basically, you're not giving the government their fair share as they might see it, okay? When you go to sell that property, there is a tax called depreciation recapture. It's a recapture tax. That tax comes out at 25%, and that's the first tax that's going to come out when somebody sells an investment property. So all the years that you've been owning the property and depreciating the property, that's going to be taxed at 25%. If you've had a property for a long period of time, that number can get up there pretty quickly. Now, the next tax an investor is going to face is going to be the capital gain tax. These are long-term capital gain tax rates. You have the rate of 15%, and then there's a 20% capital gain tax rate. If a taxpayer, if they're married and filing a joint return, and their income is more than $450,000, or if they're single and their income is more than $400,000, you're going to be faced with 20% capital gain tax rate. Anything below that is going to be taxed at 15%. What comes up a lot of times, people go, well, I'm probably in the 15% tax bracket. Well, you might be when you start, but once you calculate what your gain is going to be, if you don't do an exchange, the gain could throw you into a higher tax bracket. So keep that in mind when you're making your analysis. And hopefully, like I recommend to everyone doing an exchange, you're consulting your tax advisor early on. Now, the next tax an investor faces is called the net investment income tax, most commonly known as the Obamacare tax. If an investor is making more than $250,000 and they're married, $200,000 if they're single, they're going to be faced with an additional 3.8% in taxes. Now, for the folks in California, we might have some people that are out of state, but for the folks in California, there's no long-term capital gain rate. It's just ordinary rates. And the state of California back in 2012 voted itself a tax increase. So, state of California, the residents in this state are subject to anywhere from 9.3 to as high as 13.3 when they sell an investment property. And for those California residents that own property in Florida, say for example, or Texas, where it's a non-income tax state, believe me, California has their hand out because you're a California resident. So you're not escaping that tax, even if your property is in a non-income tax state, if you're a California resident. So these are the taxes that an investor's, going to face when they decide to sell a property. Now, what I would like to do at this point in time is show you the difference if somebody sells a property and then if they do an exchange. Also on these slides, right, the next two slides, I'm going to show you when you calculate the gain and then what the tax rate is going to be associated with this type of transaction. So in my example, we start with the basis of the property. So this particular investor bought a property, say, for $500,000. When you own investment property and you make capital improvements to the property, those capital improvements expenditures the year you spend it, you cannot write it off. So you have to save your receipts and make sure you have very good records. Because when you go to sell the property, that's when you can account for the capital improvement. When you make capital improvements to the property, that adds to the basis in the property. So I bought it for $500,000. I made capital improvements. I get to add $50,000. Now, we have the depreciation. Depreciation on residential income is calculated for the improvements only, not the land. So when you have residential income, you have 27.5 years that you can depreciate the improvements on a piece of property. If you have commercial property, it's 39 years. So for my example here, this particular investor has depreciated up to $150,000 on the property that they own. So now the depreciation subtracts from the basis in the property. So therefore it's lowering your basis. So now we bought it for $500,000, we had capital improvements, we add of $50,000. Now we're going to subtract $150,000 for depreciation. My net adjusted basis is now $400,000. Now I'm going to calculate what is my potential gain when I sell this property. So I have a sales price of $1.2 million. I'm going to subtract my $400,000 from the $1.2 million. I am going to subtract any cost of sales, such as title, escrow, commission. That's roughly $80,000. So my gain in this example here is $720,000. Now, let's look at what we're going to pay in taxes on this $720,000. Remember, I told you the first thing that's going to come out is the recapture for the depreciation. So 25% of $150,000 means I'm going to pay recapture tax of $37,500. Now, when we calculate the gain, we're going to subtract the $150 from the $720. So I'm calculating my capital gain rate on $570,000, okay, not the full $720. And I'm going to be figuring I'm in the 20% bracket. So that's another additional $114,000 in taxes. Because of the gain on this property, this is going to be falling into the net investment income tax. That's an additional 3.8, so that's another $27,360. Because it's $720,000, we're in the state of California, they're going to fall within the 11.3% rate. That's another $81,360. So as you can see, if I sell this property and my gain is $720,000, I am potentially subject to paying tax of $260,000 on my $720,000 profit. Now, let's look at how the transaction actually plays out. You're in escrow, you sell the property, you have to pay the closing costs. If you have loans on the property, needless to say, you have to pay off the loan. I've never met a lender that said, oh, don't bother to pay me back, you're good enough, we're fine. So they're going to expect that to be paid off. So that's money that's coming into to the closing, but is now being diverted to pay off the lender. So now at the end of this transaction, as a taxpayer, I have $620,000 cash to call mine. Of that $620,000, I have to earmark $260,000 of it to pay the taxes, both federal and state. So that means my buying power for my next property, if I sell and buy, is going to be reduced by the $260,000. So therefore, I'm going to have roughly $360,000 to put down on my next property. So using a 70% loan to value with $360,000 down, I can buy a property that averages about $1.2 million. Now, as an investor, and because it's a part of the tax code, I have an option to do a 1031 tax-deferred exchange, which now, instead of taking that $260,000 and reducing my purchasing power, I'm leaving that $260,000. Now I have $620,000 to put down, and when I do that, now the same loan to value, I can buy a property of almost $2.1 million. This is what we call the power of exchange, and that's why people consider doing exchanges, because as an investor, I get the opportunity, instead of giving the government my $260,000, I can take those funds and I can redeploy them to grow my wealth. That's why people do exchanges. Instead of giving the government the money, they're going to use those funds to buy more, to build their wealth and their portfolios. Now, when you talk about exchanges, let's talk about the pros and the cons. First of all, let's talk the pros. The advantages of doing a 1031 is the tax deferral mechanism. So, as a taxpayer, as I just mentioned, I don't have to pay the tax for the recapture of the depreciation. I'm deferring the tax on the federal tax rate that I might have, as well as the state, and also the net investment income tax. I get to defer all of that when I do an exchange. I also have the opportunity to build my wealth. So in other words, I'm preserving my cash to build my portfolio, to build my investment. Another option would be leverage. If someone has a property that there's a low leverage, I can take the money coming out of the exchange and I can use that money to buy more by using leverage. Okay? Diversification. If I have a property, say for example I have an apartment building and I want to diversify, but I don't want to stay in Southern California. I want to diversify maybe to Texas or to Indiana or to Florida or to Arizona. I can move around geographically. If I didn't want to do apartment buildings, I could possibly buy a single-family rental, or I can go out and I can buy a single-tenant triple net. So I can use the 1031 to diversify by asset class as well as geographically. If I do an exchange, and as long as I don't touch the money, once I buy the new property, I have the potential to refinance that property and pull some cash out and not pay tax on that cash through the refi. So that's another option. Other aspects of the 1031 is management relief. A lot depends on what you're going to buy. Sometimes people will go into a property where it's a single tenant triple net, or where there's management that's there where they're not having to deal with the management aspects of things. So that's another option for the 1031. The estate planning option. Sometimes investors are going to build their portfolio so they can have something for their heirs when they pass away. The beauty of the 1031 is that when you do a 1031 and you defer all these taxes, and then now you pass away and the property now gets transferred over to the heirs. Under current tax law, you get a full step up in basis to the fair market value. So if the heirs decided to get that property and sell it tomorrow after receiving it, they don't have any tax ramifications because they're selling it for exactly what the fair market value of the property is when they inherited it. Now, when you have the estate, it's going to increase, obviously, the value of the estate because of the fair market value coming into the property. But if they sold that property, all the tax that had been deferred all those years is forgiven. So the heirs are not going to have to be dealing with the capital gain tax that they were, from the party that left them the property. It's forgiven under current tax law. So that's the beauty of an exchange when people are using it for an estate planning tool. So it's not as though they're hit with potential estate taxes as well as capital gain taxes that were deferred while they owned the property when they were alive. So those are the pros of dealing with the 1031 tax deferred exchange. Now, let's talk about the cons of dealing with an exchange, so the negatives, if you will. One is you must follow specific rules. So there's specific rules that you have to comply with, and there are time restrictions to completing the exchange. The other aspect to an exchange that you have to really give consideration to when you're doing one is that your replacement property basis is going to be lower than if you just went out and bought the property without doing an exchange. Because when you do an exchange, your new basis in the property, the new acquisition amount, is going to be lowered by the gain that was deferred. So for example, if you're selling for, say, $500,000 and you're buying for $500,000, your basis in that new property is the exact same as the basis was the property you sold. But if you sell for $500,000 and you buy for $1 million, you'll get an increase in basis by that extra $500,000. So when we talk about exchanges and we talk about more, that's another aspect where more is very valuable to the investor when they're considering an exchange. The other part is the lack of liquidity, because you have to buy something, so you can't touch your cash. If you touch your cash, you're going to pay the tax. So that's the other part that's maybe not so appealing, because I can't touch my money. I have to reinvest it all into the next property. If the taxpayer has losses, you can't recognize the losses that you had. So this is something that's just so important for the investor to seek counsel with their tax advisor, because there are occasions where they have suspended losses, and you can utilize those suspended losses to possibly take some cash at the closing. Okay, so these are just some of the aspects of the cons to the exchange. We don't know what the tax rates are going to be in the future. We know what they are now, but we have no idea what they're going to be if we decide to finally sell out. And then the last thing is, remember, it's a tax deferral mechanism. It is not a tax-free mechanism. Okay, so those are the pros and the cons in the exchange. Now, I'm going to go very quickly here through the terminology of the exchange, because like I said earlier, every aspect of real estate has their own lingo. So when we talk in the 1031, we talk about boot. Boot in our world means taxable. There are two types of boot: cash boot and mortgage boot. Cash boot and mortgage boot. And when I go through the exchange equation example, you'll understand how this plays out. The other term is very important. It's called constructive receipt. When you do an exchange, you must have a qualified intermediary, or you have what's considered constructive receipt, and now becomes a taxable event. The next term is direct deeding. Sometimes people get very concerned about the fact that the qualified intermediary is becoming the seller of the property. When we do a forward exchange, the qualified intermediary never goes on title. Our documents are what we take title through, and we're telling the closing agent, the escrow officer, to deed the property directly to the buyer. So that is allowed through the 1031. Early on, we had to go on title, and then we transfer title over to the buyer. We don't have to do that. We do this all through the exchange document. The next terminology is the exchange or the taxpayer, interchangeable. Basically, that's the entity that's doing the exchange. The exchange agreement. Without an exchange agreement, you do not have an exchange. That is the linchpin that keeps the exchange in place. Exchange agreements are proprietary. Every exchange company has their own exchange agreement. There's certain language that we must have in there to protect and insulate the taxpayer from any taxable event. So that's a very, very important document to the 1031. The identification and exchange period. Remember I said earlier, you have certain time frames you have to meet. Identifying is the 45 days. The entire exchange period is 180 calendar days. We're going to go through this a little bit later. Lifetime property. It's real estate for investment real estate. That's basically what it means. The qualified intermediary, that's the role of us. We're sanctioned through the tax code to transfer the property to the buyer and facilitate the exchange, and we restrict the use of the proceeds from the taxpayer, so they can complete the exchange. Relinquish property, the property you're selling. Replacement property, the property you're buying. So these are the terms that you're going to hear most often when you're dealing in a 1031 tax-deferred exchange. Now, the code says, this is the first sentence in the code. It says, no gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment if such property is exchanged solely for like-kind property to be held for productive use in a trade or business or for investment. I always tease and say, these things are written by attorneys. Okay, can I have a comma, a semicolon, something in between. But basically what this sentence is saying, it says that as an investor, I don't have to recognize the gain, although it's realized, as long as it's on the exchange of property that I have either held for productive use in a trade or business, so in other words, if I'm operating my business out of the property, or if the property is held for investment. And if I exchange it for property that is of like kind, which I am also going to either hold for investment purposes or I am going to use for my trade or business. So there are very specific things you can do with the 1031, and there are things that you cannot and that do not qualify. So let's talk about what does not qualify. If I am an investor, or I think I'm an investor, I go out and I'm buying property, and I'm buying them and I'm fixing and I'm flipping them. Well, while I've considered myself an investor, the tax code does not consider me an investor. That is considered a dealer. So as a dealer, you do not get the benefit of a 1031. You cannot do a 1031. You cannot have 1031 treatment when you have stocks, bonds, or notes. No treatment. No treatment for securities or other evidence of indebtedness. Interest in the partnership. I'm going to focus a little bit on that. Just hit the high points on that. When somebody is buying investment property and they're buying it with someone else, and they decide that they want to take title and form a partnership, you cannot buy a partnership interest with your individual sale of your property. You must be on title to the property in order for it to be considered like kind, because a partnership interest is not like kind to what we call fee. Okay? It gets very complicated when we start dealing with partnerships and exchanges. The next two things are certificates of trust or beneficial interest and a chosen action. These are items that do not qualify and that are not able to do the 1031. Okay? All right. So the big question that I get a lot is, how long am I supposed to hold the property for it to be declared held for investment? What happens is there's nothing in the tax code that mandates how long I, as an investor, must hold the property for it to be declared held for investment. So there are a couple of perspectives that people might look at to gauge whether they think they qualify or not. The first perspective might be, if I hold the property for 24 months or more, you would think you would be safe. That would possibly be. There are cases where that's not the case because the intent wasn't to hold. Now, there was a private letter ruling back in '84 that said 24 months seemed to be a sufficient time. There's also a revenue procedure that came out in 2008 that said for vacation homes to qualify for an exchange, you had to rent it out for 24 months. So that's something else you can look to say, well, 24 months seems that that's a reasonable period for it to be held for investment purposes. Now, the second perspective might be if I hold it for at least a year or a year and a day, because now it's covered 2 tax filing periods, and also when I hold something, I get long-term capital gain rates if I've held it more than a year. Okay, a year and a day. And actually back in '89, Congress did attempt to mandate a holding period, which I guess in some cases is probably a good thing they didn't. So the bottom line is there is nothing in the tax code that says how long you must hold the property for it to be declared held for investment. This is where your tax advisor is a very integral part in helping you determine whether you've held the property long enough. Because there's a lot of times in my world, people might hold the property for about 9 months or 10 months and they want to do an exchange. Now they have to determine, do they qualify based on what they've done. over the ownership of the property for that period of time. So there's no safe holding period. Okay, when we talk about lifetime property, as I mentioned earlier, it's very broad. It's investment real estate for investment real estate. It still surprises me that today, with all the education on 1031, that I will even hear from tax advisors that saying, well, if you're selling a duplex, you must buy a duplex. That's not the case. If I'm selling a duplex, I can buy an apartment building, or I can buy a shopping center. If I'm selling an industrial building, I can buy a retail shopping center or an office building. If I have raw land, I can take that raw land and I can buy single-family homes. So it's investment real estate for investment real estate for to be declared like-kind property. Very broad. Now let's talk about the exchange equation. Remember, I told you the specific rules. Now we're getting into the details of the transaction. So when you do an exchange, there's certain rules you have to comply with for investment. You have to reinvest all of the net cash coming out of the sale of the property, and you also have to acquire property with the same or greater debt. Now there are some exceptions to that, but that can be discussed offline. Now, so for example, if I sell a property for $900,000 and I have a loan on it of $300,000, my closing costs are $60,000, I have cash of $540,000, I go out and I buy a property for $1.2 million. I have spent all of my cash. I have replaced my old loan. So as you can see in this example here, I went higher in value. I spent all of my cash. I replaced my debt. In this transaction, theoretically, there is going to be no taxable boot. Now, if I sell for the same $900,000, but I decide this time to buy for only $700,000, and I'm not buying any additional property. So now I put $440,000 down. I only get a loan of $260,000. Here's where I have both cash and mortgage boot. So I will have to pay tax on $140,000. So as you can see in this example, this is where the mortgage boot comes in. It's not uncommon for people to say, well, I don't understand. Why do I have to pay tax on the mortgage boot? I did not receive any money. When you think about what a mortgage is, it is money. It's just money that belongs to someone else. So what I like to do is show an example saying, okay, you and I are in the same transaction. I have zero debt on my property, and you have $300,000 debt on yours. Why is it that I have to spend all of my cash so I don't have a taxable event, but you only have to spend the cash you have remaining after you've paid off the loan? So when I put it that way, people start to understand why the mortgage has to be replaced when you're doing an exchange. A common misunderstanding is I only have to reinvest my profits, or I only have to reinvest the cash. Neither is accurate unless the cash happens to be with no debt. You cannot leapfrog and take your basis out and just reinvest the cash, okay? Now, here's something that's coming up quite often, and it's important for people to pay attention when they are looking at an exchange transaction. So if somebody sells for $900,000 and they're looking to buy a replacement property for $1.1 million. Sometimes folks think, I'm okay, I'm buying higher than what I sold for, but they're not watching what they need to do to defer the tax. So in this example here, they are selling for $900,000, buying for $1 million. They only put down $400,000, and they were able to get a loan for $700,000. They are going to end up paying tax on $140,000 of cash boot, because you cannot keep cash and replace it by getting higher debt. So be careful when you're doing exchanges to watch your loan amount to the cash that you need to spend, because it's not hard to misstep on this one, especially if you have low leverage properties that you came out of. So this is called the exchange equation. Now, to take you through the process of the exchange, this is what happens. When somebody is doing an exchange, say Kristen's representing you to sell your property. Prior to your escrow closing, so you have a buyer, you opened up escrow, you got agreements between buyer and seller. before your escrow closes, my documents have to be in there. I have to be the seller of your property. So before escrow closes, my documents come in. Now I am showing as the seller of the property. So what happens is when the escrow closes, the deed is going to go directly to the buyer. Remember I mentioned direct deeding? So you're still entitled to the property, but escrow's deeding the property directly to the buyer. I never went on title. Now, the money comes in from the closing. In a 1031, the taxpayer cannot touch their money. So it comes directly to the qualified intermediary. This is also when the time frame for the exchange is going to be triggered. You have 45 days from the date of closing to identify the property or properties you would like to acquire. After the 45 days, you have an additional 135 days to complete your purchase or purchases. So an exchange from beginning to end is 180 calendar days. There are no extensions to this unless there's been a presidentially declared disaster and you happen to be involved in it. Okay, so no extensions. These are strict timelines that must be met. Now, once you go out and find the replacement property, the qualified intermediary becomes the buyer of that property. So our documents are going to come in on that end. So Kristen's helping you go out, buy a replacement property. You get under contract with that. There's contract language that goes in. The escrow is opened. Our documents come in. We have the request for funds form so we can wire the funds. Now we're going to wire the funds to the closing. At the conclusion of the transaction, you're going to be on title to the property. This is how the flow of the exchange works. Now, I will tell you it looks very simple when we're doing this on a slide, okay? But when you get into a transaction, there's a lot of moving parts. So communication is a key to the success of any transaction, making sure that your agent understands 1031, that you understand and watch your 1031, because basically it's the investor's responsibility to make sure that they're watching everything that goes along as well. And then make sure the closing agent that you work with also understands 1031. So everybody has to be pulling the train in the same direction, or else there can be some very serious missteps. One of the common phrases I use is the fact that while an investor is involved in a real estate transaction, as a qualified intermediary, I'm involved in a tax transaction that involves real estate. So my role is very different. My role is to make sure to help guide you through the exchange process and do what we have to do properly to make sure that your exchange and all the documentation and the restriction of the funds are there so that your exchange doesn't falter for that. Okay, now let's talk about identifying. When you identify, there's 3 rules, but you only get to choose one of the 3. I have to tell you this is the most difficult part of the exchange transaction in most exchanges, is the identifying. You have, the first rule is the 3 property rule. As an investor, you can identify up to 3 properties without regard to fair market value, but I'm limited to the physical number 3. If I want to identify more than 3 properties, I will then now default to the next rule, which is the 200% rule. The 200% rule allows me to identify an unlimited number of properties. However, when I add up the value of those properties, it cannot exceed 200% of my sale price. So for people in Southern California or Northern California for that matter, in the Bay Area, if you're selling in your respective areas and wanting to buy in this area, unless you're selling for $30 million and you're buying single-family homes, more than likely you're not going to be using the 200% rule. Where I see the 200% rule used most often is when somebody's selling in Southern California and they're buying, for example, in Indiana or in Florida or in Texas or New Mexico or wherever, and they're buying single-family homes. I had a gentleman that did an exchange, sold for about $1.4 million, identified 40 properties, and ended up buying, I think it was 28 to 30 properties. They were all single-family rentals, and they were in Indiana. because the prices of properties are a lot less there. So he got to use the 200% rule. He didn't have to buy all of his properties. Now, if you get carried away by the number of properties and by the dollar amount, you've now defaulted to the final rule, which is the 95% rule. The 95% rule allows unlimited number of properties, unlimited dollar amount. Here's the catch. You must acquire 95% of the total values of the properties you've identified. So basically, you have to buy your entire list. Very few people use this rule because it's, if you don't, you end up with a taxable event because you did not buy the 95%. So understanding these rules, understanding the markets that you're going into is going to dictate which rule is going to be most likely that you're going to be able to use when you're doing the exchange. Now, one thing I will tell you, because this does come up from time to time, what does identifying mean? Well, identifying basically means that you're putting it in writing, okay? You're describing the property that you're buying. And when I say description, you're basically putting the address, the city, the state, and for good measure, you're going to put maybe the ATN number. It must be delivered or sent to the qualified intermediary or somebody who is able to get the identification letter, which means maybe the seller of the replacement property, maybe the closing agent for the replacement property. Very rarely does it happen there. It usually goes to the qualified intermediary. It must be sent by midnight of the 45th day. And then I already explained to you who it has to be delivered to. Here's an example of what an identification letter looks like. You've got the client, you have the taxpayer's name, the address of the property they relinquished, and then you're going to write down the addresses of the property. In this example here, I don't put in a dollar amount because it doesn't matter what the dollar amount is if I'm buying the property by myself, okay? I put all the addresses in, the city, the state, I sign it, I date it, and I get it over to the qualified intermediary. This is what identifying is. Identifying is filling out this piece of paper. Identifying does not necessarily mean you have to be under contract. That is the practical thing you should be doing. You should be under contract, but that's not the technical aspect of identifying. Here's another example of an identification letter where they're using the 200% rule. In this case here, I've got 6 properties that I've identified. And as you can tell on the identification, you're seeing all the dollar amounts. I have to put the dollar amounts now. So if I sold for $900,000 and I've identified 6 properties and it totals $1,780,000, I am within the 200% rule. So I can buy any combination of these properties that gets me to my $900,000. Now, if my identification ended up being where I identified all these 6 properties and it totaled $1.9 million, now I have to buy everything that's on that list. Very unusual that I can buy 95% of everything that I've identified. Not going to happen, okay, just from a practical standpoint. So this is what an identification letter looks like. Now, when you have an exchange, there's specific documents you're going to see. There's going to be the exchange agreement. There's going to be the assignment agreement. There's a notice of assignment, because when you do an exchange, the qualified intermediary has to be assigned into your contract, because you negotiated with buyer and sellers. You two negotiated. Now we're coming in and taking your position as the seller. That's why these documents are critical. There's going to be account setup forms, security of funds instruments if the qualified intermediary has that offering to the client. Then there's going to be the settlement statement that you see if there's any FERPTA issues, the 1099, all documents that are coming from basically the closing side. So this is the kind of documentation that's going to come for, an exchange transaction. Now, I'm going to go pretty quickly through this because I could see we're moving quickly in time. Sometimes people want to consolidate, and you can do multiple property exchanges. So if I decide I want to sell 3 of my properties and I just want to buy 1, okay, I can do that in one exchange agreement. As an investor, though, I have to be very aware of the timing, because the time frame for the exchange is going to begin at the closing of the first property. So I want to make sure that property 2 and property 3 are going to close in time for me to go out and buy my replacement property and understand what I'm going to be identifying within the first 45 days. The flip side of this, and we're seeing a lot of this in exchange transaction, is where I'm selling one property, and now I'm deciding I want to buy 3. When you decide to buy 3 properties, you have to identify them all, and you have to be able to close on that last property by the 180th day in the transaction. So multiple property exchanges are doable, but you really must pay attention to the time frames on these types of exchanges. The other aspect is you have to understand that you can only buy what you identify. So if for some reason something happens to one of the properties that you've identified within the 45 days, and now you're past the 45 days, you cannot replace any properties that are in that identification. That's why it's so critical to make sure that you understand and know what it is you want to buy early on in the process. Okay, we have Kristen. I'm going to throw it back to you for your last poll question.
All right, wonderful. Thank you so much, Dino. Before I rewind, before I launch this last poll, I just want to touch really quick on a lot of you guys are asking a lot of great questions. I've been able to get to some of them. Some of them we might not have time for tonight. If we do, we're going to have Dino answer some of those live on the air. If not, we will definitely make sure that we get to everybody's questions tomorrow. Via email or via phone call when we follow up. So fear not, we will get your question answered. I just want to apologize in advance in case we don't get to those tonight. And that having been said, let's go ahead and launch right into our next poll question. So, have you performed a 1031 exchange before? Real simple on this one. It's just a yes or no answer. Again, your answers will be anonymous. We're not going to post them or share them with anybody. It's just for our knowledge so that we know how to help you through the process when we follow up and talk to you about what your goals are. I'll give you guys just a couple more seconds here to get everybody's votes in. 5, 4, 3, 2, 1. All right, I think I've got most of you guys in here. So let's see what we said. All right, 7% of our listeners tonight have done a 1031 exchange, so maybe a little bit more familiar with this information than the other 93% who have not. So for those 93%, if you still have questions, like I mentioned, we will make sure we get to them. We'll make sure that everybody is up to snuff on all the details. And with that, thank you guys for your participation. And Dino, I'm going to go ahead and throw it back to you.
Okay, I'm going to go through this section pretty quickly, so we do have time to go through some of the questions and questions that you have. What we're seeing in today's market, these are the issues: low inventory. It's great to be a seller in the seller's market, but now you're a buyer in the seller's market. So planning is extremely important to the success of the exchange. The other aspect in the exchange that I didn't get into, because I guess I could talk on this subject for many hours, is exchange entities, investing issues. So you want to be careful that when you're doing an exchange and the qualified intermediary is watching this along with you, that the same taxpayer selling must be the same taxpayer buying. That's why I told you earlier, you can't go from an individual and buy into a partnership interest. That would not work for your exchange. So you have to be the same taxpayer selling and same taxpayer buying. We are seeing partial exchanges. This is an opportunity for an investor that might have some suspended losses, where they might be able to take some cash because they're not going to pay tax on that cash, because now they can loosen up those losses against the cash they're going to receive at the closing. The exchange transaction is not an all or nothing system. You can take some cash and you'll pay tax on that cash. We do an analysis, though, if you're taking too much cash, to see if an exchange would even benefit you. Because if you take too much cash, you're not going to benefit from the exchange if the cash you're taking equals your gain. Knowing the difference between an investor versus a dealer. As I mentioned earlier, time is one of the factors, but a lot of activity is going to determine which category the investor might fall in. In this particular market, because the properties, the inventory levels are low, there's a product called a reverse exchange. I'm just going to mention it that it's out there, it's available. It's not always doable for a vast number of folks because people actually need to have the cash from the sale to buy the replacement property. And in a reverse exchange, you're doing the exchange in reverse. You're closing on your purchase before you close on your sale, and most people need the cash from the sale to buy the property. It's a very complicated and expensive transaction. It's worth it if you have the right property and the right set of circumstances. And then the other thing to be aware of is any California investor that is exchanging outside of the state, there's new reporting requirements that came into effect on 2014 that you have to file an information document on your tax returns, an FTB 3840 form, because the Franchise Tax Board is monitoring the exchanges that are going outside of the state of California. It's called the clawback provision. It's always been there. It's nothing new. Now they have a way of monitoring when the taxpayer sells out of the exchanges, out of the state of California, and ultimately when they sell that property, now they can claw back the tax that they owed California when the property was in California. So those are some of the issues in today's market. And finally, as I mentioned in the beginning, the qualified intermediary industry is not a regulated industry. No one oversees what we do. There are certain guidelines in various states, but from a federal level, we're not regulated. So it's important to do your due diligence in the qualified intermediary that you're choosing. How long have they been doing it? What's their experience level? Who backs what they do? Where do they place the funds? Are there any audits and third-party audits? These types of questions you want to ask the qualified intermediary as a part of your due diligence when it comes to to choosing a qualified intermediary. Fee is an important issue, but it should be the last thing that you ask. Most qualified intermediaries, we all run within a matter of $100 to $200 of each other in the fees. And so it's a matter of what's the fund management, what are the restrictions, and what is the guidelines for the movement of funds. So that's pretty much the due diligence for qualified intermediary. And I don't know how much time we have left for Q&A, but I hope this information has been helpful. And Kristen, I'm going to turn it back to you now.
Thank you so much, Dino. The information is extremely helpful, and I know a lot of our viewers tonight are sitting there and they've absorbed a lot, but I know, guys, it's a lot of information and we covered it very quickly. So the question has been asked a couple of times. Yes, the presentation tonight was recorded. It's still being recorded, actually, and it will be available for you to watch. It'll be posted to our website under the Learn tab tomorrow. So you guys will all get a link to that, and you'll be able to watch it at your own speed and on your own time so that you can really go through and write down some more questions if you have them, and really try to gather an understanding. But I know there's a lot of information and it's a lot of details. So what's the next step here? We do what we call a real estate consultation. Just like all of our services, it's no charge to you. And that consultation takes place with myself or one of our other real estate advisors if you are already working with somebody. Otherwise, it's me. I will reach out to everybody tomorrow via phone or email. And this can be over the phone, it can be an in-person meeting, and it's as long or as short as you'd like it to be. And for those of you who aren't quite ready for that consultation, that's totally fine too. We want to work at your speed, your comfort level, and really work on a plan that fits you the best, that's customized and tailored specifically for your own personal investment goals. And as an advisor here, I walk you through the process from start to finish. So whether that's connecting you with Dino to get the 1031 exchange started and helping you to identify those replacement properties, whether you're just getting started and you're not quite there with the 1031 exchange, but you are looking to do some kind of real estate investing this year, that's what I'm here for. So that's what your real estate consultation is going to entail. And with that, Dino, if I could get the next slide, please. Thank you very much. So this is my information. My phone number is up here is 949-885-5162. That is my direct line here in the office. And my email address is ctabar@marshallreddick.com. So those are going to be the two easiest ways to get a hold of me. If you happen to be in the Newport Beach area and you want to pop by the office, feel free. But most of us enjoy phone or email better, so I'm down for that too. And whatever makes you guys happy. It is 7:31, so we've gone a little bit over our time. We like to keep this just to that hour. I know a lot of you have family that you want to get back to, and although I know we could talk about 1031 exchanges all night, we will pick up with your questions and everything tomorrow, like I said. So hang tight. Again, I apologize that we weren't able to get to some of them on the air. And Dino, I want to thank you so much for being on with us tonight and sharing all of your information on 1031.
My pleasure. Thank you for inviting me.
Absolutely. And Marshall Reddick investors, new and seasoned, it was a pleasure having you on the webinar tonight, and we look forward to speaking with you soon. Everybody have a great night.